Welcome back to the second Financial Intelligence Deep Dive, the first financial intelligence podcast. I hope you liked our first version of this podcast. Let us know in the comments below. We know Tuesdays are busy, so we won't waste your time anymore. So let's get to this episode. Today is Tuesday, August 11th, 2025. I hope you already follow us on our YouTube channel, Next Site Intelligence, and also on Spotify. Look us up, Deep Dive Intelligence Podcast. On today's Deep Dive, we're cutting through the noise to bring you the most important financial movements and insights from Monday, August 11th, 2025. Our source for this daily intelligence brief is Next Site, an amazing and dedicated intelligence company focused on global intelligence. They've developed their own open-source intelligence platform, Site Connect, designed to help investigators globally, and, well, their detailed reports are what we're unpacking for you today. You can explore more of their work at www.next-site.com. NextSite doesn't just provide these reports to their customers, they can even, customize them to fit specific interests, ensuring truly tailored insights. Okay, let's unpack this. What were the key financial movements and insights from August 11th, and perhaps more importantly, what does it all mean for you as you navigate the week ahead? So let's set the scene. The general mood on August 11th saw global risk appetite cooling off. It felt like everyone was holding their breath. What was truly driving that palpable caution across markets?
Yeah, it was noticeable. What's fascinating here is that this cooling wasn't random. It was almost entirely in anticipation of one crucial piece of data: the U.S. July Consumer Price Index, or CPI, report.
The CPI. Always a big one.
Exactly. That vital inflation data was due out the very next day, August 12th, and frankly, markets are incredibly sensitive to inflation numbers these days. Any whisper of rising prices can immediately shift expectations for interest rates, and, well, that creates uncertainty. Traders were clearly reluctant to add new risk, given that massive unknown looming just ahead. And this anticipation really sets the stage for a potential volatility spike once that CPI is finally released.
Yeah.
We're looking at two very distinct scenarios, really.
What are they?
Well, first, if we see a hotter than expected CPI print, meaning inflation is higher than anticipated, that could immediately reignite bets on further rate hikes by the Federal Reserve.
Right. More hikes?
And if that happens, you can expect significant pressure on equities, meaning stock prices could see a broad pullback.
Okay, and the other side?
Conversely, a softer number, where inflation is more contained, maybe even lower than expected, might just be the fuel needed to extend the summer rally we've been seeing in the markets.
So a real fork in the road, then.
A real fork in the road, definitely.
Yeah, it wasn't just the CPI, right? I imagine other factors were swirling, kind of adding to this cautious mood. Things like looming Chinese tariff deadlines or the persistent geopolitical tensions, were these playing a role too?
You're right. They certainly add to the complex picture. While CPI is clearly the main event here, these other factors, like those unresolved Chinese tariff deadlines or just ongoing geopolitical concerns, are definitely contributing to that underlying layer of caution.
So background noise, but important background noise.
Exactly. They might not be the primary catalyst for Monday's specific movements, but they're certainly part of the broader risk calculation for investors, making them less willing to maybe jump into new positions ahead of the big data point.
Got it. So with that cooling risk appetite, driven largely by those CPI fears, how did it actually, manifest in the markets? Let's zoom in on global equities, starting with the U.S.
Yeah.
We saw a slip there after what had been a pretty good winning streak. What were the specifics?
Indeed, yeah, that streak was broken. The S&P 500, our key benchmark for U.S. stock performance, it slipped a modest 0.25% to close at 6,373.45.
Okay, not huge, but noticeable.
Right. It might seem minor, but it's significant because it broke a solid 5-session winning streak, clearly signaling a pause in that market momentum. The Dow Jones Industrial Average, another key index, saw a slightly larger loss, down 0.45% to 43,975.09.
And the NASDAQ.
The tech-heavy NASDAQ composite eased 0.30% to 21,385.40. So a clear, albeit slight, pullback across the board. However, it's really crucial to keep this in perspective. Despite this single-day pullback, the S&P 500 is still trading near its record highs and remains up a very healthy 8.36% year-to-date.
So not panic stations yet.
Not at all. The real takeaway here is maybe a subtle shift towards defense. We saw consumer staples and real estate among the few sectors that actually gained ground, suggesting investors were perhaps seeking safer havens. And the broader sentiment, marked by low volatility and narrow breadth, meaning fewer stocks, were driving the market. That's a classic sign they're hedging bets, not panicking. Even the Russell 2000, which tracks smaller companies, fell 0.2%. It felt like a reevaluation day, yes, but more about strategic caution than, outright fear.
That makes sense. So the U.S. pulled back cautiously. Did Europe follow suit? Or did we see a different story playing out over there, maybe influenced by their own regional stuff?
Good question. Europe saw a bit of a mixed performance, actually, largely reflecting local factors. The FTSE 100 in London, it actually outperformed its peers, rising 0.37% to 9,129.71.
Why was that?
This was primarily thanks to energy stocks benefiting from those stable oil prices we saw, and also a weaker sterling, which helps companies earning in dollars.
The currency effect.
Right. However, the broader Stoxx 600, which covers a wider range of European companies, slipped slightly by 0.06% to 546.76. Here, losses in luxury goods and technology sectors actually offset the gains we saw in energy.
It's a bit of push and pull there.
Exactly. And Germany's DAX also fell roughly 0.3% to approximately 24,072. Trading volumes there were notably thin, again, likely ahead of that crucial U.S. CPI data. Everyone seemed to be waiting.
Okay. And what about Asia? Anything significant happening across those markets?
Asia was a bit quieter, partly due to a holiday. Tokyo markets were closed for Mountain Day, so no movement from the Nikkei.
Right.
However, Hong Kong's Hang Seng Index did manage to add 0.19%, closing at 24,906.81. But this was on cautious trading, as investors there were preparing for upcoming earnings reports. We saw some rotation into property and technology stocks, perhaps signaling a focus on domestic themes rather than those big global macro concerns.
Understood. Okay, moving beyond equities, the rates markets told an interesting story. You said they were generally stable, but with some fascinating nuances, especially around U.S. Treasury yields. What were the specifics there?
Exactly. In the U.S., Treasury yields showed a mixed bag but remained largely contained, which fits that waiting theme. The U.S. two-year Treasury yields edged up just a modest 1 basis point, that's tiny, 0.01% to 3.78%.
Okay.
In contrast, the 10-year yield eased slightly to 4.271%. This suggests investors were indeed staying on the sidelines, not making big bets before the CPI release. The 30-year yields ticked up marginally to 4.85%.
So short end up a hair, long end down a bit.
Pretty much. The key takeaway here, though, and this is important for understanding market sentiment, is that despite these slight movements, this left the 2S10's curve still inverted by roughly 49 basis points.
The inversion persists. And remind us, what does that mean for our listeners?
Right. An inverted yield curve, where short-term bond yields like the 2-year are higher than long-term ones like the 10-year, is often seen as a signal of investor concern about future economic growth, maybe even a potential recession down the line.
The classic warning sign.
It's a historically watched indicator, yeah, because it suggests the market expects future economic conditions to be weaker, which would normally lead to lower long-term rates. So the inversion deepens slightly, which is noteworthy.
And Europe's bond yields, did they follow the U.S. pattern or did their own regional factors dominate?
They definitely reflected regional factors more. The German 10-year Bund yield actually rose to 2.69%.
Rose? Interesting.
Yeah, and that was reportedly after what were described as hawkish comments from European central bank officials, so indicating they might be leaning towards tighter monetary policy, which naturally pushes yields higher.
Okay, so the ECB sounding tough.
Seems like it. Meanwhile, the UK 10-year gilt yield actually fell to 4.57%. This decline came amid softer UK housing data, which perhaps suggested less inflationary pressure or maybe a weaker economic outlook in the UK. So kind of contrasting signals there between the ECB and the UK picture.
Fascinating divergence.
Yeah.
Now, you mentioned low volatility earlier, especially with equities. What about the volatility gauges themselves, like the VIX?
You're right. They certainly did remain surprisingly subdued. The CBOE VIX, often called the Fear Index, closed at approximately 15.55 on August 8th, which was the latest available data we had for the report.
That is pretty low.
It is. And even more striking, perhaps, the IC Move Index, which specifically measures Treasury volatility, bond market volatility. It fell to 79.2. That's its lowest level since way back in early 2022.
Wow. Lowest in over 2 years for bond volatility.
Right.
Before a CPI number.
Exactly. This raises a really important question. What does such low volatility, especially in a historically volatile asset class like treasuries right now, suggest? Is it market complacency or just deep uncertainty keeping people on the sidelines?
It feels maybe a bit too quiet.
It does feel a bit like the quiet before a potential storm, doesn't it? For our listeners, this complacency, if that's what it is, could mean that markets are either overly confident in a soft CPI print Or maybe they're just not pricing in the full potential for a surprise either way. Definitely something to think about.
Absolutely. Okay, let's shift to foreign exchange. The report mentioned the U.S. dollar actually strengthened modestly across major pairs. What's the story there?
Indeed. The ICE Dollar Index, or DXY, which tracks the dollar against a basket of major currencies, it rose to approximately 98.52. That's a 0.34% gain on the day.
Okay.
And this extended its month-to-date gain to 0.71%. A strengthening dollar like this often signals a kind of flight to perceived safety or an expectation of higher U.S. interest rates relative to other economies.
And how did that impact the other big currencies?
Well, it had a clear ripple effect. For
Right.
instance, the euro DSD slipped to 1.1615. This likely reflected market anticipation of potentially soft Eurozone growth data, making the euro less attractive compared to the dollar.
Okay, sterling.
GBP USD also eased to 1.3430. That happened even despite some signs of resilience in UK employment data that came out. It suggests the dollar's broad strength was kind of overriding local factors for the pound.
Right. Dollar was king for the day.
Seems like it. USDJPY advanced to 148.0. This continued move higher for the dollar against the yen is largely because Japan's yield curve control policy remained unchanged, keeping their interest rates pinned down low compared to the U.S.
And the yuan.
The onshore US DCNY rate reached 7.1951. That rise in the dollar against the yuan came amid those ongoing concerns over China's property sector, which tend to weigh on the Chinese currency.
So connecting this to the bigger picture for businesses listening, a stronger dollar isn't always good news, is it?
No, definitely not for everyone. It can put significant pressure on corporate earnings for companies that have large foreign revenue exposure. When they convert those foreign earnings back into stronger dollars, they get fewer dollars.
Right.
So risk officers really need to be monitoring their hedging strategies in this kind of environment. Currency movements can directly impact profitability, sometimes quite significantly.
Good point. Okay, turning to commodities, we saw a pretty mixed picture there on August 11th. Can you break that down for us? What moved?
Yes, quite mixed is the right word. Oil prices held relatively steady, suggesting a kind of balance in supply-demand expectations, maybe also waiting on that CPI data. West Texas Intermediate WTI crude settled just 0.13% higher at $63.96 per barrel.
Okay.
And Brent crude was up even less, a tiny 0.06% at $66.63 per barrel. So oil was pretty flat.
But not everything was flat, right? What about metals?
No, definitely not. We saw a clear slide in precious metals. Gold fell quite sharply, 1.6%, down to $3,344.64 per ounce. And silver dropped nearly 2% to $37.59 per ounce.
Why the drop there?
It was largely attributable to that stronger dollar we just talked about and also slightly higher real interest rates. Those make non-yielding assets like gold and silver less appealing to investors who are looking for returns.
Makes sense. Industrial metals.
They were also weaker. Copper dipped 0.7% to $4.43 per pound. That was primarily due to those ongoing concerns over Chinese demand, as China is such a huge consumer of copper. Natural gas also eased a bit, closing at $2.97 per MMBtu.
So from an operational standpoint, say for a chief investment officer watching this,
Yeah.
what are the implications?
Well, continued dollar strength could certainly weigh further on metals prices, and it's really important to keep a close eye on those Chinese demand indicators, especially for copper. China's economic health, or lack thereof, directly impacts demand for these kinds of raw materials.
Got it. And shifting gears one last time to real estate, what did the report tell us about mortgage rates and the housing market?
On the real estate front, the trend was actually positive, for borrowers at least. U.S. mortgage rates continued their gentle drift lower. Freddie Mac reported that the 30-year fixed-rate mortgage averaged 6.63% for the week ending August 7th.
Still high historically, but drifting down.
Exactly. Drifting down. The next update on this is due out on August 14th. This decline in mortgage rates reflects that easing we saw in Treasury yields, and it's generally expected to support refinancing activity for homeowners. Could potentially free up some household cash.
And for businesses in the housing sector.
For housing-related businesses, this means they really need to prepare for potential rate volatility following the upcoming CPI and PPI data. Any surprise in inflation could quickly reverse this downward trend in rates, impacting housing affordability and demand almost immediately.
Okay. And finally, to wrap up our market overview, how did crypto assets fare amidst all this? Were they moving much?
Crypto prices remained relatively stable, actually, almost in a holding pattern. Bitcoin was trading around $119,282 and Ethereum near $4,250 based on the latest data we had from August 10th for the report.
So quiet there too.
Very quiet. Market participants are clearly awaiting both further regulatory developments, which are always a big question mark in crypto, and that broader macro data like the CPI we've been talking so much about. Trading volumes in cryptocurrencies also remain pretty subdued. That's been the case since the approval of several U.S. spot Bitcoin ETFs earlier in the year. It seems like that initial excitement has maybe cooled, and now it's a waiting game for the next big catalyst in that space.
Okay, so putting it all together, based on this intelligence from Monday, August 11th, what should you, our listener, really be looking out for in the coming days?
Right.
What are the key strategic implications to keep top of mind?
Right, the bottom line. Well, the primary catalyst, no surprise, remains that U.S. July CPI release on August 12th. That's the big one that will likely set the tone for the rest of the week, possibly longer.
Okay.
Beyond that, the report highlights several key operational watch items and their implications. First, for chief investment officers, there's significant inflation risk. A higher than expected CPI print could easily push Treasury yields higher and put pressure on what we call high duration equities, those stocks most sensitive to interest rate changes, often growth or tech stocks.
So portfolio managers need to be ready?
They really ought to be considering hedging their interest rate risk, especially going into this release.
Okay, what else?
Second, for CFOs and Treasury departments, funding costs are a key area. While short-dated U.S. yields rose slightly and long-term yields fell, leaving that curve inverted, the MBE index, remember, bond volatility being near two-year lows, suggests maybe a degree of market complacency.
Which could be an opportunity.
It might be. Opportunistic issuers might look at this as a window to lock in funding at perhaps more favorable rates before volatility potentially returns with a vengeance after the CPI print.
Interesting. Third point.
Third, for risk officers, keep watching that dollar strength. The U.S. dollar strengthened against most major currencies, which, as we discussed, directly pressures corporate earnings for companies with significant foreign revenue exposure. Monitoring hedging strategies for currency-sensitive operations is absolutely critical here.
Right, managing that currency risk.
Yeah, exactly. Fourth, for CIOs, again, that commodity softness is something to watch. Gold, silver, and copper all sold off as real rates rose and the dollar strengthened. Continued dollar strength could weigh further on these metals. And again, keep a close eye on Chinese demand indicators for copper.
Okay, and the last one.
And finally, for CFOs and Treasury departments, again, that mortgage rate trajectory is a key focus. With Freddie Mac's 30-year mortgage rates averaging 6.63% but potentially volatile, housing-related businesses should definitely prepare for potential rate swings following the upcoming CPI and Producer Price Index (PPI) data. Any shift there could directly impact their business models, from refinancing volumes to new home sales.
Excellent summaries. So maybe a final thought for our listener to chew on. Given the market's current cautious stance, this waiting game feeling, and especially that historically low volatility we're seeing in Treasury markets, how might a surprise in the upcoming CPI report, whether it's significantly hotter or maybe softer than expected, how could that fundamentally reshape immediate market sentiment and maybe broader investment strategies for the rest of the week? Something to consider. Don't forget to follow us on YouTube and Spotify. Also like, share, and comment. We do look forward to hearing your opinion. This is it for today. Enjoy your start of the week.